Greetings, y'all. It's Alex here again, giving you your daily tips. So on buying your first property, um, when you're buying your first property, the three main things that you need to worry about are usually income, your credit score, and how much you have in savings. Your income, it needs to be from a reliable source. Usually they want you to have your job for like a couple of years, but that's not always necessary. You can have a new job if it's in the same industry that you've been in for a while. Um, or if it's something that you went to school for and you have a degree in, something like that, then if you just show your last couple of pay stubs, then they usually take that as viable income. Um, by the way, when you do try to go for your first property, you should probably go to a private lender. The reason why private lenders are important is because they give you the same benefits as a lender from, let's say, Wells Fargo, or a Citibank, any of the big banks really. But private lender gives you the same rates, but it's easier to get approved because they don't have as many people coming to them, so they don't just like choose the lowest risk people and send everyone else off, send everyone else away. Also, you don't have to, as long as you so if you find a private lender, look up their MLS number, and that's kind of their license number in a way. They will have one that you can look up to verify them, and that means that they're solid. The reason why they're reliable is because if they mess up something, they get in a lot of legal trouble, and they're very trackable through the MLS number that they have, that license number. So they don't make mistakes because they would end up in jail pretty quickly for it and lose all of their business. It's just not worth it, the risks for them. So find a private lender, apply with them, and they'll give you probably the same tips I'm going to give you, but just to help you get an idea of what the process is like. Your income needs to be viable. You need to be able to afford the property. So they look at your income, they look at, do you have a debt obligation? How much do you have to pay each month? And they want to try to make sure that you can, that you make about 2.5 times what the mortgage is going to be. So if your mortgage is going to be like $1,000, you should be making $2,500 a month. That's a pretty safe amount. They do that because the average person has trouble paying their bills if it gets too far out of that ratio. And also there's some legal standards to make sure they're not loaning to someone who is not financially responsible. So it would suck if they gave you that loan, you didn't pay it off, and then you were stuck owing a lot of money for the rest of your life. So they actually have a legal obligation to not qualify you, even if you promise with ample evidence that you're responsible. So don't take it personal if they keep the bar high for you to meet. So the other two things are credit and savings. So with credit, your credit score usually is fine if it's at least, I think, 640 or 650 usually can make it. You can get your credit score for free once per year. Just go online, look, just Google it, search it, whatever you want to, however, and find how to get your one free credit report. You can also do it. Credit Karma is a great website for this. You can usually see kind of a guesstimation of what your credit looks like without it taking a hit on your credit. If you pull your report more than once per year, then you do take a small hit on it, but it's nothing big, and it goes away within a few months. It shouldn't really impact things at all, but avoid it if you can, in case every little bit does make a difference in your situation. So with your credit score, the higher it is the better rates you get because you're less of a risk. You're more likely to be responsible and pay off your debts. If you need help with building your credit, then good options for that are, starting with people with no credit. Okay, if you have no credit history, get a couple of credit cards and just hold on to them for a year. Get secured cards, so you'll pay about $200 to the bank, and you'll borrow from that money. The money you gave them, you're going to borrow your own money from them on the secured card. Just borrow like $1, pay off like one thing per month, keep it in your wallet, have it like in the front of your wallet so you remember to use it, and after you use it, put it to the back of your wallet, and every time the first of the month comes around, flip that card back to the front of your wallet so you remember to swipe it once before flipping it back again. Set up auto pay on this credit card. If you automatically pay it off every month after the statement of what you borrowed and before the interest collects, then you'll pay 0 interest on what you borrowed, but the statement will still show that you borrowed something. So your credit will increase because it will show that you borrow money and that you pay it back. If you're not using the card at all, or if you pay it back too early before the statement shows that you borrowed something, then you then it looks like you're not using it, you're not doing anything. They have no data they can really gather on that, so there's no statistics for them to think that you fall into the responsible category of people. So with the card, these cards usually graduate automatically. So make sure that you have one that does. You can get it, I recommend getting it through a major bank, just because they'll usually have more features. It's easier to track, it's accepted more places, it's usually just convenient to do. And once it graduates, you get your money back on how much you put into the card, and then you'll have what's called an unsecured card. So then you would actually be borrowing from the bank instead of borrowing from your own money that you gave them. So having that card, you'll be able to build your credit the same as if you had a regular credit card, and it will help you boost your credit up to the point you need to get it to. If you already have credit cards, then I recommend making sure you're making payments on time. That will increase your credit score. No matter how bad your situation is, if you're making payments on time and paying like the lowest minimum balance at least, your credit score will increase. It will go up. You just have to be patient with it. Other tricks you can do is make sure you're not, don't close accounts if you can help it. Closing accounts does reduce your score a little bit. And other things you can do, your credit will get to 650 pretty easily. If it's already at 650 and you're trying to increase it higher to get a better rate before you go into getting a home, let's say you're just still saving up money in your savings account, or you're still in school trying to get the job to get the viable income, then I recommend either taking out another credit card, only if you only have one. You want to keep your credit cards to about 2 or 3. If you have more, then that's okay as long as you're paying what you owe on time. But if you only have one card, I recommend getting a second card. The second card I would just stick in your closet or cut it up and don't even use it. Set it to automatically pay off your phone bill, Netflix, something cheap, $15 a month. Forget about it, let it pay off automatically every month after the statement collects, but before interest collects, and that way you will, your credit score will increase for the rest of your life for free. You don't have to do any work with that. Another benefit is sometimes credit cards give you a percentage back. I have credit cards that give me a percentage back on gas, or a percentage back on anything that I purchase at Amazon or things like that. So if you purchase pretty much everything through like Amazon and Target or in gas, and you have 5% back, you get 5% back on your entire life. So that's like 5 years of income at the end of your life or something. I'm not sure what it actually shakes out to, but that's the way I like to imagine it. It's a fun thought. But doing that, it's free benefits, free credit score. It's pretty helpful. Got my credit score up to 813 pretty consistently. It bounces back and forth depending on if I'm purchasing a property that month or not. So as for the actual savings, if you're struggling with saving up money, then you should probably figure out a budget. That can be difficult to do, and especially if it's, you have trouble. A lot of people struggle with motivation, and so I would start with something simple. Something simple you can do would be maybe just saving $5 from each paycheck. Set it automatically to go into a savings account that you don't touch no matter what. You pretend it's not there. No matter what's happening, you pretend it's not there. You should only touch it if there's a medical issue, if there's something that's going to stop you from making your income, because then it'll, your savings should save money. It should save you costs that you would normally have to pay. So if you have to take out a loan to get a car so you can make it to work, or if you're going to lose other money from not having a job, then it should save your job. It should save you on medical expenses. If you get sick for a week and you need to afford your rent, you should be paying your rent so you don't have worse problems later. So it can help you in those situations, but you should pretend you don't have it until the very last moment. Pretend that you have to find some way to come up with like that extra $1,000 or whatever the case may be, That's the only way that it will survive. Otherwise, that money will be gone. And keep in mind, I'm only saying to save $5 a week or $5 a month at first, so it really will not go far. Start with $5 for payment and then increase it, and make it an amount that you will feel ridiculous for not putting in there. That way, there's no motivation involved. You can do $5 from every paycheck, even if you're like struggling the most. Usually, people will agree that they can put $5 into there, and they'll figure out the rest. They'll pick up another hour of shift somewhere, or save money somewhere, cut their Netflix spending, whatever, and then each month increase that until you're at a higher amount. And once you get to where you're able to save a few hundred a month consistently, then that's going to go towards your future, whatever it is that you're trying to build, whether it be purchasing a car instead of getting a loan, which will save you a lot of money, or doing a down payment on a house, or starting up a business, or whatever the case may be. But you'll be off pretty well. So there you go. Those are my tips for if you're looking at getting a home for the first time. Cheers.